You work hard for your money, right? You save it, you do all the right things, but every single year there's this invisible force just eating away at its value. Well, today we're going to talk about how to fight back, how to protect what you've earned from inflation. And this really gets to the heart of the problem, doesn't it? The whole system feels like it's punishing you for being a saver. So if just holding onto your cash is a guaranteed way to lose, what's the move? What's the alternative? Where does your money actually have to go? Not just to get ahead, but just to survive. I mean, think about it. You did everything you were told to do. You followed the rules, put money away, planned for what's next. You lived within your means. You took the safe route. You built up that cash emergency fund thinking that keeping your money right there, secure and accessible, was the absolute smartest thing you could do. And yet, after all that work, all that discipline, you look at your bank account and it just feels like you're treading water, right? Like you're running on a treadmill. Well, that's because there is a silent force working against you. So let's break down exactly what that is, and more importantly, what you can do about it. Okay, let's get into it. To really understand the solution here, we have to look at the problem in a totally new way. And believe it or not, we're going to borrow an idea from physics to help us make sense of the economics of your money. Now, we all know the textbook definition of inflation, right? Investopedia says it's a persistent rise in prices that erodes purchasing power. Okay, sure. But it's so much more personal than that. A better way to think about it? It's a hidden tax on every single dollar you've saved. It's basically a tax on doing nothing. And this is where we're going to completely reframe how you see your money. There's this really fascinating paper on something called economic thermodynamics, and it gives us a great analogy. Let's think of your cash as kinetic energy. It's active, it's ready to go, you can spend it, but it naturally loses its charge over time. Now, assets, things you own, they're like potential energy. They're stored value that holds its power. The folks who wrote that paper put it perfectly. They say that inflation is basically the growing distance, or the scale, between your kinetic energy, your cash, and the potential energy you want to acquire, like a house or a stock. And as that gap gets wider and wider, the power of your cash just shrinks. So, okay, if cash is this kinetic energy that's constantly leaking power because of inflation, what does that actually mean for our strategy? Well, it means that standing still is the fastest way to lose the game. Holding cash feels safe, but that feeling is an illusion. Here's the hard truth. It doesn't grow. It doesn't adjust for inflation. Its actual purchasing power is constantly, slowly decaying. Cash is a fantastic tool for short-term stuff, liquidity, emergencies, but it was never, ever designed to build or even hold long-term wealth. And that right there is the key takeaway from this whole section. Your money simply cannot sit still. To keep its power, it has to be converted from that leaky, kinetic energy into something more stable. It has to be put to work. It has to move. So, what's the solution? Well, this leads us to what I call the principle of ownership. And it's going to require a really fundamental shift in how you think about your money. We have to focus on converting that depleting energy into something solid, something stable. What does that shift look like? It means going from a passive mindset to an active one. It's about moving from simply saving cash to owning a piece of the economy. It's going from just holding currency to participating in creating value. And it's shifting from storing your money to actually, strategically deploying it. Here's the core strategy in a nutshell. If inflation is just the price of everything going up, then the simplest way to protect yourself is to own the things whose prices are going up. You want to be on the other side of that rising price tag. Okay, so what does that look like in the real world? Let's get practical. Let's break down the main types of assets, the forms of potential energy that let you put this whole principle of ownership into action. All right, first up, productive assets. We're mainly talking about stocks here. When you buy a stock, you're owning a small piece of a real business. So when that business has to pay more for its own supplies, what does it do? It raises its prices. And as an owner, a shareholder, you get to benefit from that. In fact, research from Hartford Funds shows just how effective this is. The energy sector, for example, has managed to beat high inflation a whopping 74% of the time. Next up, we've got real assets. Think real estate. This one's pretty intuitive. When inflation is high, the cost to build a brand new house goes up. That makes existing houses more valuable, right? Plus, if you own a rental, rents can be adjusted upwards to keep pace.
That same data from Hartford Funds shows that equity REITs, which are basically big portfolios of income-producing real estate, have beaten inflation 66% of the time in these kinds of environments.
Now, if you want a more direct way to fight inflation, you can look at something called TIPS. That stands for Treasury Inflation Protected Securities. These are government bonds where the actual principal value automatically adjusts upwards with the official inflation rate, the CPI. Sounds perfect, right? Well, not so fast. As RBC Wealth Management is quick to point out, they're not a silver bullet. They can still lose value if interest rates rise too quickly. So that's a really important catch to keep in mind.
So what happens when inflation spikes unexpectedly? I mean, when it really catches everyone off guard. This is where commodities really shine. Check this out. Research from Parametric shows that during these periods of surprise inflation, a mixed basket of raw materials has delivered a mind-blowing average quarterly return of 7.53%. Why? Because commodities are the literal building blocks of everything, and their prices are the first to react. And that brings us to hard assets, with gold being the most famous example. It's really, really important to understand what gold is for. It's not a growth engine. It's not supposed to make you rich. Think of it as financial insurance. Its job is to preserve your wealth, especially when things get chaotic and people start losing faith in regular currencies.
Okay, so how do you put all these different pieces together? Well, one classic strategy is something called the permanent portfolio, created by Harry Brown. It's designed to be safe in pretty much any economic weather. The idea is simple. You just divide your money equally, 25% each, into 4 different buckets. You have stocks for when the economy is growing, long-term bonds for when prices are falling, gold for when inflation is high, and cash for when there's a recession. And this really brings us to a huge mistake that so many people make. They're always searching for that one magic bullet, right? They're constantly asking, what's the single best investment to beat inflation? But that is completely the wrong question to be asking. See, the real goal isn't to pick one winner. The question you should be asking is this: how do I build a system that protects my purchasing power for the long haul, no matter what crazy thing the economy decides to do next? The answer isn't one asset. The answer is a strategy. A strategy built on ownership and diversification.
So let's wrap it up with this thought. The laws of this economic physics are crystal clear. Inflation is a force of nature. It punishes inactivity and it rewards participation. Money that you just leave sitting there, that kinetic energy, is going to slowly but surely lose its power. The real key to survival and eventually to growth is to convert that cash into assets, into potential energy that can actually stand the test of time.